On our next panel, we are going to be talking about capital markets in Bitcoin mining, and we are going to have Grant Switzer from the Stand With Crypto group, correct? Is it Stand With Crypto? PwC. Oh, apologies. You're right there. Yeah. Come on up and be able to moderate this panel. So, Grant, come on up, and thank you so much. We appreciate it.
Thank you. Yeah, thank you. Yeah, of course. Again, my name is Grant Switzer. I'm with PwC, PricewaterhouseCoopers. I'm a partner in our national office, work in a group called SEC Capital Markets. So work on a lot of capital market transactions. And why don't we just go, Luigi, you want to give them a little background, who you are and your company?
Hello, everyone. My name is Luigi Ambrosi, and I lead business development for Enhanced Digital Group. Started my career as a quant trader for an hedge fund in Switzerland, then moved to Goldman Sachs in London, where I was an equity derivative structurer. Enhanced Digital Group is an institutional-grade provider of derivatives and structured products and crypto assets. We help institutional investors to access this new asset class. And most importantly for this crowd, we help Bitcoin miners to protect their balance sheet and to have more predictable and stable cash flows. And what's unique about us is that we don't custody client assets, we don't lend, we don't mine, we only trade derivatives and options.
Sure. Thanks, Luigi. Tucker Highfield. I'm the CFO of GDA. GDA is one of the largest Bitcoin mining companies in the world. We currently run 19 data centers. We have a global presence. We build our infrastructure, so we're kind of an owner-operator model, and we don't have any customers, so it's 100% self-mining. We currently have 11 facilities in the United States, 5 in Kazakhstan, and 3 in Sweden. And we'll be announcing another small one in another country shortly. Look forward to a lively discussion.
Hello, I do not have a cool name like Tucker or Luigi, but my name is Matt Williams. I work for Luxor Technology. We are a Bitcoin infrastructure company, run a mining pool. We have firmware, we mint ordinals, we do ASIC brokerage. My background, much like these guys, is in traditional finance. Spent several years as a commodity trader, both oil and gas and agriculture. Worked for CME Group for 5 years and was part of the team that launched Bitcoin Futures back in 2017. And then spent 2 long years at a regulator before joining Luxor about a year and a half ago. The division that I work for does hash rate derivatives, and we launched OTC marketplace for people to transact in hash rate derivatives and use it as a tool to kind of manage their revenue risk.
All right, Tucker, why don't I start with you? You with your investment banking background and now an operator, CFO of an operator, how would you, just as a broad question, how would you describe the institutional capital markets in Bitcoin mining right now?
Sure, thanks. Before I get started, I also just want to thank Texas Blockchain Council for kind of hosting us all. I think it's been a great event, so I think that's important. Look, the capital markets is difficult. I would say capital formation, both in the public markets and private markets, has been challenging. Part of that is just overall macro, and some of that is specific to the Bitcoin mining space. I think that a lot of people talk about volatility in crypto, and that's probably the biggest deterrent for institutional investors to come into the space. And there's 2 aspects to it. One, no one can predict the Bitcoin price, and people thought they could predict the hash rate, but turns out that they're not very good at that either. And so those 2 inputs, if you think about it as like numerator and denominator of a miner's profitability, it's very difficult for institutional investors to predict those things, the inputs into their models. So that volatility is the biggest challenge. I think the more important question is kind of where we're going from here. Bitcoin's one of those assets that has asymmetric risk. So, if Bitcoin really rips, you can see a market where Bitcoin miners can get capital. So price is obviously one aspect of getting comfortable in the capital markets. But the other one, and I think the more important one, is volatility. So I think we're of the belief, I know it's not a consensus view, that network hash will start to moderate. So you'll start to see lower growth rates in the network, partly because of the base effect of it being very high now, but also because infrastructure limitations are out there. you know, the regulation, weather, all of these things, electricity prices for that amount of consumption, getting laborers to actually build facilities and things like that is challenging. So I think there's a natural limitation to network growth from here. So that's one element of volatility. And then I think the other is when you see the institutionalization of, you know, Bitcoin from a price perspective, whether it's an ETF or, you know, whether it's, you know, ordinals or whether it's, you know, higher transactional services in the global south, those two play off each other to start to create a lower volatile price environment. And I think that lower volatility is, we all want to see the price go up a lot, but the lower volatility is more important to capital formation. And I think, you know, as we think about it, I think the halving is a natural point in time between network hash being very high and the halving impacting economics, where you could see that lower volatile environment throw in a little bit of consolidation in the space, organic or inorganic consolidation. And you could see a much more investable, I would say, environment for Bitcoin miners. And my personal view is that's where we're headed. You know, it might take another year or so, but I think that's the next era of this kind of wildcat mining period of capital raising, I think is a more stable, institutionalized thing. And I think once people get that done, then they realize that what you're actually investing in a miner is a really, really, really cheap implied volatility option. It's a really, really mispriced call option. If you believe in Bitcoin price and you believe it's going to go up, but you need
a high beta to Bitcoin.
With a high beta to Bitcoin. So, but you need those two inputs to become less volatile in order for real institutionalization to occur.
Thank you. And Tucker, you live outside the U.S. and Dubai.
Dubai.
Yeah. Be interested in your perspective on foreign capital as well. Are you, in terms of any sovereign nations, sovereign wealth funds, are there new interesting capital providers coming to the global market?
I mean, I've spoken to most of them. You can kind of bucket them into the Canadians, the Singaporeans, the Middle Eastern guys generally that do international equity. You know, Bitcoin mining falls under, you have half of it that's infrastructure, and the other half of it you have to really understand consumer applications, right? Like, you know, payments infrastructure, ordinals, like what's actually happening on the network layer. And the combination of those two skill sets don't really exist in the traditional silos of institutional investing. So I'd say the group that is probably most forward thinking are the Middle Eastern groups. The Singaporeans have kind of like a no crypto policy or pseudo no crypto policy. The Canadians are quite conservative. They do some, but they're quite conservative. The Middle Eastern guys they understand it. The ADQ in Abu Dhabi, they own a subsidiary that has 500 megawatts running in Abu Dhabi, so they understand it. I'm not sure they understand fully the financial models yet of these businesses, but they're keen to get exposure.
Any comments on this last question of capital markets in general from either one of you, Matt or Luigi, or otherwise I'll move on to some derivative questions.
Yeah, let's do it.
All right, I'll go to Luigi first. So my background is I come to Bitcoin from the energy side and very familiar with energy hedging and just the maturity of that market and the ability to protect capital and protect operations through the use of derivatives. You talked about structured products and mainly option, right? So tell us what is the state of the Bitcoin option market, the depth, liquidity? What are you seeing out there in that?
Look, I mean, there's no doubt that this industry has changed a lot in the last few years, especially compared to what the average Bitcoin miner looked like before the last two halvings. And again, miners have understood the importance of having a cheap cost of capital because investors mainly want predictable and stable cash flows. And trading options and derivatives can help you to achieve both. Because similarly to large multinational corporations who have their production costs denominated in one currency and their revenues denominated in another currency, we are seeing a lot of miners who started hiring professional CFOs and treasurers who are well-versed to protect their balance sheet and their EPSs against large swings in FX exchange rates. So why we are all hardcore Bitcoin believers, we all think we're going to the moon sooner or later. To get to the moon, you need to survive the bear markets. And trading options allow you to transform the volatility of such an asset from the liability side to the asset side of your balance sheet and to monetize it. And look, there's many things that you can't control. You can't control for ASIC prices. You can't control for your energy costs. You can't control for the difficulty of the network, but you can definitely control for the output of your production. And the output of your production is definitely the dollar price of one Bitcoin that you mine. And what's been really interesting for us is that we are seeing more and more miners who adopt an hybrid approach to their finances, in the sense that they don't commit to hodl or their production, neither to sell or their production, but they are much more tactical and opportunistic in terms of what they do, because they understand their liquidity needs, their liquidity cycle, and they try to plan for their OPEX and their CAPEX expenditures. And what's really common is that usually Bitcoin miners tend to buy protection against a move down in the price of Bitcoin and finance this protection via renouncing to some upside. So in more technical terms, what you do is you buy a put option on Bitcoin and you finance it via selling a call option. So you obtain what's called like a zero cost package, in the sense that you don't have to pay any initial premium to enter in this trade. And what's unique about this asset class is that if you look at the economics of Bitcoin, it's unbelievable. You can buy a 30,000 March 24 put, and you can finance it via selling a 60,000 call. So it means that you buy protection if Bitcoin goes below 30, and you only renounce to gains when Bitcoin goes above 60. This was priced a few weeks ago for a client when Bitcoin was at 35K. Now, can you see how asymmetric it is and how attractive? Yeah. And this is like the whole reason why we launched DDG, because we are all derivatives traders and structures, and we looked at this asset class with this insane vol surface. And we said, okay, everyone in the world must be hedging because it just looks so attractive. And now, obviously, after the last 2 years and all the drama that happened in the market is adopting a lot of the standards from TradFi. So there are a lot of serious counterparts out there. For example, we are only based onshore. You don't have to go in any remote island in the Pacific if you want to sue us. Hopefully you don't want to sue us, but you can find us in New York or in London. And the market is developing. You can trade size. There is 24/7 liquidity, and I would encourage everybody to look at options on Bitcoin.
I would too. And that's really unusual to see that pricing too, because at least coming from an energy background, to 30 and 60, that's you're giving up upside, but you're capturing almost 100% upside before you give anything away, and you're protecting your downside almost entirely. So I'm surprised they're not all hedging.
Yeah, look, it's insane. As long as I'm aware, there's no asset class like this in the world. Yeah. And the reason for that is that Bitcoin has what's technically called a positive spot vol correlation. Like a spot rallies, people tend to buy more upside. All the diligence out there who tend to buy calls. But if you're on the other side and you want to hedge, you actually want to buy put and sell calls. Yeah. That's the best you can get.
Yeah, thank you. Okay, Matt, we'll move to you. I know your firm is not just options, but energy, hash rate derivatives. I'm really interested in if you could speak on the hash rate derivative and kind of where we are in terms of maturity of that and what you're seeing. Are companies buying that for protection of the balance sheet, cash flows?
Yeah, I would say typically when I'm talking to people about our hash rate derivatives, you kind of break it down into the risk exposures that the miners have, right? And the risks that they have to mitigate. And so, Luigi's talking about their treasury risk with their Bitcoin and how to manage that. And there's tons of derivatives that exist in that space. And energy, power is king. And when you're planning out that risk, and there's power derivatives, there's, WTI, there's nat gas, there's, a myriad of options for you to manage that risk. But when it comes to managing your revenue risk around your hash rate, historically speaking, there was nothing, right? It's a concept that existed, but the marketplace just didn't support it. We started building our OTC marketplace in October of last year. So we're now a year old, but still very new, I'd say, in the maturity path. And, we're growing liquidity and the marketplace is evolving. And, we have the ability to now do, for miners to hedge multiple exahash on this market, but it's still very much an educational thing in this space. The mining world wasn't built by a bunch of TradFi guys, talking about derivatives. It's built by tech guys that, are interested in Bitcoin. And so a lot of times when you're talking to miners, they didn't have the expertise. And, Luigi talked on this a minute ago. So what we were doing is we were going out and kind of, starting with 101, like what is hedging, what are derivatives, and you really have to distill it down into the value of a derivative to someone. But now flash forward to now, and it's like literally 12 months later, people are either hiring the expertise, CFOs with a background, they're hiring trading teams to manage energy, treasury, and now hash rate derivatives, or they're, educating themselves. And I think a lot of the impetus behind the momentum that we have right now, like the last 3 months alone, we grew 300% in volume. And I think it's because people are, starting to realize, hey, we got to see what tools exist for us going into the halving, because there's a very real event that's going to happen sometime in April. You got to be prepared to manage all those risks, and you have to figure out, we think in terms of hash price, like what is the expected value you can get from your hash rate, right? And that could be in dollar or Bitcoin terms. You really, if you're a miner, you got to think about like, what is my break-even hash price, and what is it going to be post-halving, and figure out what that number is. And we've looked at a number of public miners, and the median for that is like right around like $42, right? And so you need to figure out how you manage that. Like, how do you get that lower, and how do you hedge against the risk of that? And so coming out of and there's a fair amount of people that are above that number, and so. Right now we're lucky because the transaction fees right now, hash prices this morning was in the 90s, which is incredible. I don't know how long that's going to last, but we know if you take it tomorrow, the halving's tomorrow, that 90 is going to be 45, right? And it's probably going to be lower than that. So you have to prepare. And I think we're seeing people ramp up and getting prepared for that. And so from my perspective, like, it's not just us too. There's other people that are providing hedging around hash rate derivatives. It's a growing space. We've launched 2 products now, and we have designs to do more. But yeah, it's nice to see the maturity path growing. People are getting educated and participating.
And how far out can you go with a liquid market before it gets illiquid or too expensive?
Yeah, so right now, our markets go out 6 months, and we have liquidity across all 6 months, both in USD and Bitcoin denomination. It does get, if you look at the forward curve, people are, right now we're past the halving in our market, so you can kind of see where people are pricing it, and it's steep the further you go out. There's a lot of uncertainty around hash price, so the spread widens, but, it's still liquid enough that you can hedge and protect yourself.
Good, thank you. So talking about the halving, and you mentioned importance of getting the hash price down. I'd be interested in Tucker and Luigi thoughts on the halving as well. I mean, if from a capital standpoint, if a capital provider is interested in investing, is it good to plug in now, get the ASICs plug in now? Do you wait and see with the halving, or there may be some distressed opportunities? How should capital being deployed be thinking about halving at this point?
Well, I think generally one rule of mining is time is money. So if you have an ASICs and you have access to power, you should plug in whenever you can. So that's why we've seen this huge network hash rate. It was really equipment order. What happened is everyone over-ordered equipment in 2021. Then they renegotiated those contracts in 2022, and then all the equipment got delivered in 2023. And so that's why you've seen a doubling of the network hash this year, is because of that cycle. So again, it should I think normalize and start to grow a little bit at a slower rate. Look, the halving is going to be partly obviously dependent on price. I think you have to think about it in price scenarios, kind of at the current levels, at lower levels, at higher levels, and what that means. I think from an equipment perspective, if you look at kind of what's plugged in right now, it's quite clear that 20 or 30% of the equipment that's out there is going to be obsolete. So unless you see a very significant price rise, that's kind of the delta of the network hash that's going to drop in April. Maybe we all get bailed out and Bitcoin's 65 and things stay plugged in for longer and network hash kind of continues to grow.
Can't bank on it.
But that's not a business model. That's, as my CEO says, that's gambling. So
Hope is not a strategy.
Yeah, and then I think from a GDA perspective, it's all about costs. So, we have low fixed costs. We manage our power very effectively from that cost input. And then obviously cash on the balance sheet. I think everyone's going to want a buffer of cash on the balance sheet for the uncertainty. And institutionalization, look, I think if you picked a miner that you were very confident was going to survive well through the halving, it's a good time to give that miner capital. It's not clear, that picture is not super clear right now. And I think as you get closer to the halving, I think that institutional capital injection probably becomes less and less likely until the dust settles and you see what happens. So you're talking about maybe some normalization of capital coming into the system, mid next year, fall next year. So
The markets don't like extra uncertainty, I imagine, with the halving. But
but forget about like March, April. It's a write-off. So either you find a large capital provider that really loves kind of the management team, the capital discipline. Not all miners kind of fit that profile. So, you wait to see what happens in terms of kind of living through and surviving the halving.
Luigi, perspectives on halving?
Yeah, we think there is a significantly underappreciated risk of a supply glut in hash. And I like to draw a parallel to what happened with oil in 2015 when oil fracking came to market in the US. And there was this huge amount of supply of oil that came to market. And usually markets don't have the capacity to absorb such huge spikes in the supply. And the oil price went down 70%. So, you have all these long-term projections of hash growth rate, which are extremely bullish. But we think in the near term, there is a risk for us going significantly down because there is a significant numbers of miners which will go probably out of business because they're just not competitive at these prices, obviously, unless Bitcoin rallies massively. And what this means if you're a miner is like two things. If you think you will not be profitable after the halving, you must absolutely make sure you extend your lifetime even by a couple of months because that might make all the difference in the world given how volatile Bitcoin is. So you buy yourself time. So if you have some margins now, you should try to lock them as much as you can. Or if you think that you will survive, you won't have any issue, well, you must absolutely be certain that that's the case no matter what happened to the Bitcoin price because you will have a lot of opportunities to scoop distressed assets from the market. Right. And I think there will be, a very significant opportunity for the strong miners out there.
Good, thank you.
Yeah, just to add on to that, I think a lot of what Tucker and Luigi said is totally accurate. I think for people preparing going into halving, ideally you've already done whatever you can to lower your energy costs. If not, it's probably too late. But, refreshing your machines, getting more efficient. I think having dry powder to, extend your runway a bit coming out of it, I think is super important. Just overall, kind of contributing to your strategy of, like I said, getting your your break-even hash price as low as possible because, it's coming and it's a real thing and people are going to have to manage it. But I also think, having that dry powder afterwards, I think there's going to be some, as you said, there's going to be some opportunities for distressed assets. There's going to be opportunities for consolidation. So the people that do have the dry powder post-halving and do have that low break-even hash price are going to be really well situated.
Good, thank you. Okay, we have a little over 5 minutes left. Any questions from the audience? All right, we have one here. Here, I'll bring a mic.
All right, thanks for that. Are you seeing a lot of new lenders in the space, given the fact that a lot of the old lenders have now gone bankrupt? Are you seeing new capital providers in the debt and equity space, specifically the debt space?
Not really, I think is the short answer. There's one, One happened, I guess, last week with kind of Tether's loan to Northern Data. I think that's quite a unique pool of capital. Systematic providers of debt don't really exist, I would say, right now. I think you can think about the credit market, from an ASICs perspective. So there's obviously a lot of machine collateralized loans in the last cycle. Those basically didn't work out, and a lot of lenders now own a lot of ASICs. There's electrical equipment, so there's some very expensive, substations and transformers and things like that you can borrow against. That market exists, but it's quite niche and not well understood for Bitcoin mining. And then there's kind of a concept of a sale and leaseback, right? Where you have a facility, you lease it out, or you sell it basically on terms, and sometimes with abilities to buy it back, ROFRs and things like that. And there's a huge market for that in traditional real estate. But what we found is that just because of, again, the volatility of Bitcoin, from a sustainability perspective, these are guys that they look at annuity revenue for 10 years, 20 years, and they have a hard time modeling that. So even though that should exist because there's so much real estate investment that's out there, it's very, very difficult to find the investor that can match those two things up and feel comfortable with the risk profile. So the main source of capital, has either been private investment from kind of family offices at kind of the low end, some national level investment, which we kind of know is happening in like places like Bhutan and Abu Dhabi. And then public miners that have liquidity have been able to sell into that liquidity via ATMs. So the vast majority of capital over the last 18 months has been through, liquidity transactions in the public market on the equity side.
Yeah, we're pretty much seeing the same thing. We talk to a lot of miners that are seeking capital, and it's really hard to find. And when you do, you're getting predatory rates that are unmanageable. It's actually kind of led us to start exploring different avenues to get miners capital. We've been working on a product that we launched where miners can sell their hash rate forward and get Bitcoin up front, get advance on their forward production. So they're using assets that they already have to get Bitcoin in advance, and in turn, buy more ASICs, grow their fleet at a lower cost of capital than they're getting, through financiers if they're able to get it. But the truth is, like, the space needs a lot more products like that and access to capital. It's just, and some of it is on the miners themselves. Like, they've kind of put themselves in a hole where they're not, credit worthy sometimes. Some are better than others. But, it's true. Like, there's a lot of risk, and we learned a lot of lessons over the last 18 months. So, the miners that have cleaned themselves up and are more responsible will have, better access to capital going forward.
Yeah, the credit, like the miners' credit rating, if you want to call it that, none of them are actually rated, but like the credit quality of them, I think has changed pretty dramatically. So now even just giving deposits for electricity is you have to give quite a long runway of pre-deposits in order to secure electricity, which wasn't the case when you had $200 million on your balance sheet. It's a very different game. So if anything, I mean, the capital markets have gotten tighter, but there's also been non-capital market related restrictions around some of your cash, which has made it, even more challenging.
Yeah, totally agree.
Any other comments from the panel as we close out?
Just a quick one on my side. If anyone's interested in edging, we organize a small event later today, so please come ask me for more details if you're interested.
Yeah, I'll have the same offer. If anyone has any questions or wants, deeper dive into what we offer, go talk to Luigi.
Yeah, GDA, we keep all of our products, so we don't have anything to offer you guys, but very happy to have side conversations with anyone afterwards if they like.
All right. Well, thank you so much. Thank you. Thank all of you. I appreciate it. Thanks for your participation.
Thank you, guys.
All right. Thanks.
Hey guys, thanks for coming out to the 2023 North American Blockchain Summit. It was the best summit yet. We look forward to hosting you again next year. If you enjoyed the summit or like what you saw in this video, be sure to subscribe. If you're interested in learning more about membership in the TBC, go to texasblockchaincouncil.org to learn more.